Hey folks, I'm Chris Shank and I'm your mortgage advocate. Today, we're following the dollar to learn about mortgage-backed securities and how they affect your future. Congratulations, viewer! Earlier today, you got a letter informing you that you had a rich aunt who died recently, leaving you an inheritance of $10 million. Thankfully, by watching this video, you've proven yourself wise beyond your years. You're also quite resistant to temptation because you're watching me rather than cat videos or reaction shorts. Because of this, you managed to also resist the temptation to buy and then wreck a very expensive sports car, and instead decided to make your very own mortgage company, Awesome Mortgages, Inc. The premise is simple, really. You've seen a closing statement before and know that over the life of your standard 30-year loan, the borrower is paying around 100% of the home's value in interest. Judging by those numbers, it only makes sense to back $10 million worth of mortgages and then roll in all that sweet mortgage money immediately afterwards. So, fast forward a few months. You've written $10 million worth of mortgages. You've prepared a swimming pool to hold all the money you're about to rake in. But that pool is taking a long time to fill. You see, let's say that you wrote each of these mortgages at 6% interest. In 30 years, you will have collected around $21 million back in principal and interest payments. Each month, though, you're only raking in around $60,000. I mean, that's a fair bit of money, but you've got a business to run. Payroll, employee benefits, the rent on your office spaces, that $60K is going to disappear fast. As my dad is fond of saying, oatmeal is better than no meal. You know that this block of mortgages will make money in the long run, but what you need right now is a quick profit, so you decide to bundle these loans together and sell them to a second party for a cool $12 million. Boom. Now you've got the capital to pay off those business expenses and refill the pool that you can lend with. If you're savvy with your money, you can even increase the size of this pool to increase the number of loans you can back at any given time. This is literally how mortgage companies grow from small teams of less than a dozen people into industry giants with billion-dollar reserves. Now, for the sake of our example, let's say that you're now comfortably swimming in that pool of money, but you're still curious to learn what happens to the loans that you sold. Most likely, the loans you sold made their way to a trust who then bundles like loans together into something called a mortgage-backed security, hereafter referred to as an MBS. From here, investors purchase shares in this MBS and receive regular payouts based upon the principal and interest collected from the mortgages that make up that particular MBS. This form of investing is viewed as low risk because the only way that a particular MBS will underperform is if a significant number of its component mortgages fail. Thankfully, factors like regulation-driven underwriting and mortgage insurance reduce the chances of an MBS underperforming significantly. Due to the resiliency of real estate in this country, mortgage-backed securities remain a solid long-term investment strategy for investors who would rather count on a steady return on their investment, such as insurance companies, banks, and pension funds. So, there you have it. Your mortgage, in addition to keeping you in your home, is being used to help prop up your insurance company when the rising costs of claims eat away any operating budget they may have started the year with. At times, it can get confusing to understand what's going on in the wide world of finance, but as long as you follow the dollar, you're bound to learn something interesting. This is Chris Shank with Mortgage Advocacy. Thanks for watching.